Today, you can hear home prices falling. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, evidence is mounting of home price falls spreading more broadly across the country as the impact of higher mortgage rates filter through to bank lending standards and household budgets. And it's worth reflecting on the fact that when the RBA announces a cash rate hike, it can take a month or two for that decision to hit the real world. So we're only just now seeing the fallout from the first rise in May hitting the streets, and there are more to follow. The so-called borrowing power is curtailed, which means that people can borrow considerably less than a few months ago for a given set of income and expenditure parameters. And as shown in my recent anti-spruik videos, vendors are having to meet the market. Economists are continuing to call larger falls ahead, following the trend already set by Christopher Joy for up to 25% reduction over time. The latest is that Australia's housing market is set to drop 18%, according to one major bank, and new data shows that regional areas are joining Sydney and Melbourne in the slide. As the ABC reports, the prediction of an 18% slump in house prices comes from ANZ, which has slightly increased its forecast fall based on the Reserve Bank's aggressive interest rate rises. ANZ's economists expect the RBA to hike its cash rate to 3.35% before the year is out, which would send typical variable mortgage rates close to 6%. We expect capital city prices to fall 18% over the balance of 2022 and 2023 before a 5% gain in 2024 as mortgage rates fall, ANZ senior economist Felicity Emmett and Adelaide Timbrell wrote. The biggest factor driving prices lower is reduced borrowing capacity, not a rise in forced sales. Arrears rates are coming from a very low base. Households have built up large liquidity buffers, and the rise in the share of loans in negative equity is expected to be modest, they said. And the economists point to a large reduction in maximum loan sizes as banks test whether mortgage applicants can service their loans at much higher interest rates than earlier this year. Our forecast for the cash rate to reach 3.35% equates to a reduction in borrowing capacity of nearly 30%, they noted. This reduced ability to pay up will drive prices lower over coming months. Already, housing finance data shows that average new mortgage sizes are beginning to fall. ANZ's forecast is in line with other major financial institutions, with Commonwealth Bank's economists expecting a decline of at least 15%, even if the RBA cash rate only reaches CBA's forecast of 2.6%. ANZ's economists say a tight rental market, rising immigration, and low unemployment would help to mitigate the decline, but it would take a forecast reduction in interest rates to see the market start to turn around. In 2024, they said we expect to see the beginnings of a recovery in house prices alongside cuts in the cash rate in the second half, and we expect prices to rise around 5% in 2024, the economist added. They're forecasting the biggest falls this year in Sydney and Melbourne, the most expensive capital city markets, and therefore most exposed to the effects of reduced maximum home loan sizes. As with the smaller capital cities, ANZ expects the increase in interest rates and reduction in borrowing capacity to eventually hit previously buoyant regional housing markets. And so new data from CoreLogic suggests this is already occurring in some of the most expensive regional areas, where reductions in maximum borrowing capacity due to rising interest rates again have the biggest impact. The real estate research company says the largest quarterly falls in house values occurred in the Richmond Tweed region, down 4.5%, followed by the Illawarra, down 3.5%, and the Southern Highlands and Shoalhaven, down 3%, all in New South Wales, with the latter two areas within 2 hours' drive of Sydney. The two key southeast Queensland regional lifestyle markets of the Sunshine Coast and Gold Coast also saw house values decline over the past 3 months by down 2.5% and 1.2% respectively. Typically, markets with a higher median value tend to lead the broader market when shifting through different cycles, CoreLogic said. After recording some of the strongest value growth throughout the COVID period, each of these areas now have a median house value in excess of $1 million. As we move further into the downward phase of the cycle, we would expect to see this decline in values spread to more regional areas. Over the past year to July, regional markets posted an average 17% rise in house prices versus a 5.4% increase in capital cities, where the major markets such as Sydney and Melbourne were already falling from their pandemic peaks. And CoreLogic said New South Wales Riverina region was the best performer among regional housing markets, with an annual increase of 27.8%, followed by Wide Bay in Queensland up 26.8%, and New England's Northwest and New South Wales up 26.4%. And CoreLogic said they expected the fall in regional markets to spread, but perhaps not to be as great as that in some of the capital cities. It's possible the regional areas will be slightly more insulated than the capitals thanks to those markets' relative affordability and low advertised supply levels, they said. So the question now becomes, how far will prices fall, and will they reverse the remarkable run-up that we had through COVID when rates were cut and government incentives were to the fore? Well, bearing in mind that the biggest lever to impact home prices is the availability of credit, and tighter underwriting standards means less credit, prices will indeed likely fall further, which then takes us to what levers such as higher migration, reductions in lending rules, or more government incentives might be thrown at the market to try and stem the falls. But with rates still expected to go higher, according to the latest from the ASX 30-day market trends, we should still expect more falls, and falls that some will find shocking and others, well, it will just be a financial disaster. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.